What's going on, traders? Welcome to the channel. I'm John. That's Groot. We trade options here. All right, market is up a little bit. Uptrend still confirmed. You know, I still feel like it's kind of frothy, and Palantir's had a good move higher. I do have some expectations that perhaps if the market turns around a little bit more, this may go lower or so. However, what I'm going to do is take advantage of this rise in Palantir price. So by doing this, what we've got, I'm going to use something called a covered call strategy. I actually own 100 shares of stock, and by owning 100 shares, you can sell against those 100 shares. So it's almost like saying, hey, I've got 100 shares as collateral, and for that, I'm going to take on a little bit of risk. But the beauty here is if the stock goes lower, I pocket all of the money that I'm betting against my shares. And then if the stock goes higher, like say it just somehow keeps shooting higher, well, then I don't lose money at all. I actually just lose my shares. These are the collateral that I take on. So I'll explain that a little better, but let's jump in. I'll show you this trade that I'm doing in real time. So what I did is I go to Palantir options. I'll do that again for you so you can see. So when you're in the stock, what you do on the lower section up here is where you can buy shares, sell shares, that kind of thing. You're actually going to want to go to Palantir options here. So I'm in PLTR options. As usual, as you've seen from previous videos, the important stuff is kind of at the top, and then we got our strike prices below. So basically here, the important thing is picking your expiration date. What I'm going to do is go to the next cycle. I think this is like 30 days out. So every third Friday is a monthly expiration date. And so I'm going to go out to September for expiration. So by doing this, I give myself some time, and there's a couple components. So it's saying, hey, we've got a time in place, and we're setting this contract up to say, hey, by this day, I'm making a bet that we don't go past, you know, this price level kind of thing. So let's go back to the chart, and I'll kind of show you what I'm looking at, because these strike prices will kind of dictate the bet I'm going to make. So as I go back to the chart, you can see here I've got some established lines. 28 is approximately the next level of resistance. But here's the thing I like is there is another technically like kind of lower resistance below that at about 2750, but I like just having that zone of 28 there just so you can see. So I'm going to give myself kind of a buffer, and to give you an idea there, I'm probably going to be looking at like say the 29 or the 30 strike, which would be about like here. Right, so what I'm saying is, hey, even if the stock goes here and comes back down, or if the stock goes here, we're good. But if the stock goes higher, if it goes above this level to like here, then that's when I lose my 100 shares. But I lose them at that level, so it's technically a profit of whatever that net difference is. So to explain that better, I'm looking at, say, the 29 strike or the 30. I like the amount of premium I get for the 29 strike. So what I'm going to do is I want to make sure I'm on call, and then actually I want to sell. So I'm selling a call against my 100 shares. And then if I selected the 28 strike, I'd get about $71 in credit. If I sell the 29 strike, it is less credit, it's less premium here at $53, but I also would get $100 of gains from if my shares got called away. It's a great way to look at this, and how I can explain this better again is this profit and loss diagram. So my expected profit and loss, if we're at expiration and we're anywhere from $29 and lower, then I'm pocketing all of that money. If it's any higher, my break-even price here is $29.53 in the stock. So it's basically that $53 or 53 cents. You just add it to the 29 to get your break even here. And then anywhere higher, it does say I'm at a loss, but keep in mind, since I'm actually doing my shares would get called away at this level. And basically it's like I put in a limit order to sell my Palantir shares at that price. So how I can explain that, let me go back again really quick. So if you look here, I own 100 shares at this average cost. So what happens is if you take like say 29 minus, let me get out my calculator, minus 24.45, well then that's 455. So that's $455 profit on top of the 57 or whatever that was for that. Let me go back here. Boom, September 17th, sell. And let's go to the 29 strike one more time. Oh, it's going lower now. So, oh no, actually it was 53, I think. So I pocket a little more. So I'd get that $455 plus the 54. So that's basically a $500 profit on Palantir going higher. Now what's kind of cruddy is, let's say if Palantir shoots let's say it doubles, it goes like $50 a share. Well, I sold my limit order at this level at 29 basically. And that's a kind of a bummer in a way because I capped my upside. Maybe I missed out on those gains, but what's the probabilities that it doubles, right? Versus maybe just stays in this range. And there's no perfect answer, but I will tell you generally a doubling or higher is usually a much lower probability than staying around a 2, 3, 4, 10% move type of situation. So for that reason, I'm going to enter this because the stock is up about 10% today. So for that, I'm willing to take this. And then to give you an idea here, I have in my other account, I have about 300 shares of notional value in Palantir. So if it goes higher, fine. I'm happy. I'll capture that too. Now let's just read this really quick. It says collateral 100 shares of Palantir. Boom, got it. And then you are agreeing to sell 100 shares at this level. So this is basically like the limit order to give you an idea. If you are not asked to sell Palantir by this date, by September 17th, you'll keep that collateral and the full $50 of credit. So that's basically how to generate a very simple income. And in a way, it's like passive, right? Like, boom, you set this order in and then you just go to work or, take care of family, whatever you're doing. So it does make it a little easier to kind of pocket this. Okay, and that order has been placed. It has not been filled yet, but maybe I'll try and go just a little bit lower to see if it fills. So let me make this 0.53. And we'll go from there. So instead of that 0.54, let's do 0.53. Perfect. So it looks like we did get filled, and you'll see here contract sold, new position, my collateral, and 0 commission. So basically, like we said in Palantir, I've got until September the 17th or something like that, 27th, whatever the third week in September is. See, that's the best part, is like I just said it and I kind of don't care. Now here's the thing, you don't have to actually wait until expiration. So for example, if say Palantir goes lower, well then I might capture that profit even sooner. Maybe I'm at $30-$40 of profit in like a couple days or a week. Well, I might want to actually close that out. So I just basically buy to close that trade, and then I just reset the probabilities. Next time Palantir kind of moves higher, time to sell another covered call against it. So if you think about it in terms of accelerated dividends, it is a very powerful tool to have. This is much better than say having, some people will put like $50,000 into a dividend stock, and then you got to wait 3 months and you get like $10 back in dividends, right? Or something like that. So you can use options as leverage. It's very, very powerful. But you can also use options in a very bad way, and the risk gets higher, and you can also lose that money just as fast as you earned it. So keep that in mind. That's what's nice about a covered call. It's a relatively safe, easy to use trading strategy where your collateral is already there. The biggest risk, honestly, is if we have massive moves higher or massive moves lower, because if you're owning 100 shares and they continue to drop, fine, that's great that you got some income, but it's not so great that you're still holding on to shares that now have lost a ton of value. So that's really the risk, is if we're way higher up here or if we're way lower from its current trading position. But if it's just in a nice little range like you almost see here, that's perfect. That's the exact best way to trade income. Or if you find like a relatively stable stock, but one that kind of moves, that's a good quality company, there seems to be less risk of it dropping, that's a good move too.